gentlemen, today we are going to analyze the losers as well as the winners in REITs in the first half of this year. We're also going to ask you essentially, what does the winners and losers portend for the second half of this year? Well, this actually coincides with our latest publication. You can see it at GCP Global website under gcpwixsite.com/GCP Global, where we actually publish our monthly research for the last 33 years. Yes, 33 years. So let's hit on to it. We question whether markets have reached maximum pessimism. But you know what? It doesn't matter whether the markets basically have reached maximum pessimism or the fact whether we have already are discounting the bear market conditions. I think most importantly is that, as we have highlighted many times, the key thing in making money in REITs, that is making your millions in REITs, as published in my book in English, Making Your Millions in REITs, is to be able to know when to ferret out the bargains, when they are selling at dirt cheap prices. This is a time where you don't expect any analyst or fund manager to tell you it's at the bottom, because everybody will be telling you that it's only appears on a high side basis. Of course, for my book, if you want to look at the Chinese publication, the equivalent, which is published in the US and China, you can actually order them through online itself. Now let's rock on. In our position as a smart investor to rip the millions that you can make in REITs. Now, moving on, first and foremost, in this week's video, we're going to divide into two. This week's video, we are going to analyze the losers. Okay, next week's video, and do sign on and be our subscriber, because every week we post a good video on real estate investment trust to help you enhance your wealth. So next week we will be talking about the winners. So back to this week, we are talking about the losers. Now you can see, ladies and gentlemen, that the top two REITs that were losers for the first half of this year is EC World REIT and Digital Core REIT. Ladies and gentlemen, do look at our last week's video where we talked about why did Digital Core REIT crash so badly. Okay, so other than the fact that they will be facing huge interest rate spikes in the REIT, because of the fact that only 50% of its loan portfolio is on a fixed basis, you'll notice that essentially there are other negative factors pertaining on Digital Core, which we will have highlighted in our classes, as well as our video last week, as well as in our video, which we actually mentioned way back when they IPO'd, because we were questioning at that time whether essentially many of the corporate governance issue pertaining whether a REIT owning a REIT, so the sponsor for Digital Core is actually Digital Realty, listed in the US. Is this a conflict of interest? Now, if it's not a conflict of interest, then how does a smart investor draw the line? Whether the management has crossed the line? Because, ladies and gentlemen, most of the time, even any whiff or suspicion of that is enough to send the share price crashing. And you've seen it in Digital Core, and I leave it to you to actually judge whether essentially it is actually one of these particular reasons. Now, investors in our classes for the last 2 years to stay out of office REITs in the US. That includes Prime REIT, which crashed 15%, or rather 19%. Manulife REIT, which have consistently underperformed and is down 15% even in the first half of this year, as well as Keppel Old Pacific REIT, which actually is down 12.5% for the first half of this REITs, have many issues. Many of the issues are highlighted in our publication and our write-up. Do read about them. You notice that the problems that Manulife face and Prime REIT faces are not much dissimilar, and what do you as a smart, savvy, sagacious REIT investor must do? Do read our publication as well as our YouTube video. Now, if I may, I'll just use Cromwell just as an example to actually exemplify why any of these 10 REITs that underperform and crash and lost in terms of capital value in the first half of this year. Look's presentation mentioned that it completed 430 million in light industrial logistic acquisition. Wow, sounds very big. Don't forget, ladies and gentlemen, who is paying for their acquisitions? It is actually shareholders, because the manager and the sponsor makes 1% of the value. And remember, they also make 0.5% of the sales value when the assets are being sold. So if we just look at the acquisitions, that's 430 million, only in the light industrial, not talk about the other office assets, then you notice that the fee that the manager have earned is actually 4.3 million since the beginning of the year. Sounds fine if shareholders are actually on board in the same direction. But one of the problems that we have with value traps, like Cromwell, is that since 2 years ago, for example, as high as recent as third quarter of 2020, you notice that they have shown and given us charts from all the countries that they actually have assets, including Denmark, Netherlands, France, the Czech Republic, Germany, Slovakia, Italy, United Kingdom. Oh my goodness. I mean, you need to follow the property dynamics of all these countries if you are going to invest in this or have invested in this REIT. But what happens is that most of this are a little bit confusing, in the sense that you notice that all this vacancy rates seems to suggest that in all the areas that they are operating, other than this particular chart, the occupancy rates are coming down. Now, as a simplistic REIT investor, now this is supposedly be the good news, because if vacancy rates come down, it means that occupancies go up, tight market for the assets. It means that the reversionary rental should go up, right? But if you actually look at the higher reversionary rental, if it does come through, it will feed through NPI and DPU, correct? And then that is where your share price should go up. But what happens to Cromwell? Oh my goodness. Since 2020, other than the global financial, or rather the sell-off during COVID-19, you notice that the share price crashed by almost half. Okay, but more importantly, ladies and gentlemen, is the fact that after the COVID-19 sell down, you notice the share price has never recovered back to its original pre-pandemic price. Now, then, of course, as an investor, you will simplistically ask, what is wrong? Okay, so one of the key things that is what is wrong, or it is what is not supporting a higher share price, is the fact that higher vacancy is not translating into higher reversion, or at least higher reversion rentals is not translating into higher NPI, and you're not getting a higher NPI means that you're not getting a higher DPU as a shareholder. That's why you notice that Cromwell has continued to underperform. In fact, for the last 2 years, since the pre-pandemic, the share price have actually collapsed from 2.675 at the beginning of 2020 to currently less than $2, or a loss of 26%. So yes, some website, some investors, analysts have pointed that this REIT is paying 8% dividend yield. But you know what? If you take the 8% dividend yield since the last 2 years, it's still not sufficient to actually compensate for your 26% capital loss. The next one is actually coming out on 13th of August. What do? Well, we are just like the Top Gun movie. We help you to avoid the danger zone for REITs. Okay, so if you're happy, you want to join us for our class on 13th of August, do sign up and catch the early bird special, which is still prevalent, because in our classes, we're going to talk a few things on REITs. One is the fact whether the 10-year bond yield that actually exemplify the cost of funds for REITs have actually peaked. We also look at, well, cost of funds go up, 10-year bond yield go up. Does it mean that the current dividend yield have sufficiently compensated for that? If it